The dominance of Superman spread all over the world. Not only the evil superheroes and meta-humans suffer because of Superman, the gangsters are also furious. Planning to destroy Superman, three gangsters brothers meet Lex Luthor to ask for Kryptonite Stone, which reportedly that he has had the stone. Unexpectedly, Lex Luthor asks for a very, very expensive price. The gangsters, who do not have enough cash to buy, try to find a way to fulfill the expensive price requested by Lex Luthor. And came the tremendous idea of the gangsters to double the money, bring in forex teachers to learn about stocks. Stocks. Yes, the stocks.
Hello everyone.
Hello. Oh yeah,
How
are you, man?
How are you, man? I'm good.
You look nice, yeah?
Okay, I'm good. Okay, I have your message and I already knew about your case. Okay, I will accept your request. I will teach you about the stock, but maybe I don't teach you today. I will teach you for the next meeting. But before we meet at the next meeting, I hope you learn first about the book, about this book.
What kind of the book, eh?
The title is How to Make Money in Stock by William G. O'Neill.
Okay.
Okay, this is the book. Please read and learn in detail. In the next meeting, you can ask me anything, and I will teach you about the stock. And I hope it will solve the problem to get a lot of cash to defeat the Superman.
Okay. Yeah. Huh? Are you sure, yeah?
Sure.
Okay.
Brother, we have read the book How to Make Money in Stock from G. O'Neill. For this whole week, as promises, Bram will teach us future about this, how to make money in stock. But first, what do you think about William O'Neill?
William G. O'Neill. I've heard about him before in jail. My friend from jail told me the story about him. This guy is seriously big deal. You know what I'm saying? He's an American entrepreneur, stockbroker, and writer. He was born in Oklahoma City, March 25, 1933. He studied in Southern Methodist University before beginning his career as a stockbroker in 1958. First with Hayden Stone and Company, he is also the founder of Investor Business Daily. But in 2016, Investor Business Daily announced that it would shift a weekly distribution and that it would focus exclusively on online content.
That's right, brother. But what do you think about the content of the book?
Well, I've heard this book has been sold for more than 2 million copies, and it is a bestseller. The first part is a technical part. The first 100 pages of this book is actually telling about chart. So O'Neill emphasized that you have to be able to read chart, understand charts, and to be able to trade correctly. There are many patterns of charts. Some are cup with handle, saucer, flat bases, ascending base, highlight flex, and double bottom. These continuous chart patterns provide investor with a confident choice whether the stock will appreciate or depreciate. Well, understanding these charts won't give you guarantee also to be right every time. There is just no such thing like that in the stock market.
That's true, man. Well, to be clear, let's Bram explain to us. Go ahead, bro.
Okay, good morning, gentlemen. As I promised before, to start today, I will explain about the books divided by 3 parts. Part 1 is the winning system or canceling. The section explains how to reap profit from stock. William O'Neill, in this section, described the method he thinks is the best in stock investing. The best way of investment in stock by William O'Neill is canceling method. Canceling is 7 letters by William O'Neill as the most important thing to consider when playing in stock. For the first is C, current quarterly earning per share. The percentage increase in earning per share is single important element selection stock. The key factor in here is how much the current quarter earnings are up in percentage from the same quarter the year before. For example, third quarter earning of 2015 should be greater than the quarter earning of 2014, and the important accelerating earning should be supported by accelerated sales.
Okay, so what the minimum increase in the quarter earning?
I think in canceling method, it is no less than 18% to 20%. But many successful money makers use 25% or 30% as the minimum earnings per letter. The second letter in canceling method is A. A is annual earnings increase. You must select stock with 25% to 50% annual growth rate of the company, and you must check the stability of the company's 5-year earnings record.
So, is it important to look for the stock with significant growth?
The third letter is N. N is new product, new management, and new expansion plan. You must search in company that has key new product, new management, and new expansion plans. If a company can fulfill some of your criteria, then we see a new consolidation pattern finding at price chart. You have to purchase stock as soon as stock brings consolidation.
Oh, I see. So anything new is a good indication of a successful company.
Yes, correct. Next is S, supply and demand. The stocks should have less number of outstanding because less shares outstanding increase liquidity, so price can rise and fall quickly. If you are choosing between two stocks to buy, one with 10 million shares outstanding and the other with 60 million, the smaller one will usually be the rewarding, and you choose low corporate debt to equity. It's usually better.
So, share outstanding and a big volume demand?
Yes, correct. And now, anyone can explain about the L?
Okay, this is what I thought about L.
L represents leader or lagger. Which is your stock? If we're analyzing an industry, we want to look at the top 2 to 3 stocks in each industry. Having a mindset of finding a company that isn't having the same success when compared to leaders of the industry is usually wrong. Even though the leaders might carry a higher PE ratio, it's usually justified because these companies are much better at profiting than their competitors. It seldom pays to invest in stocks that are laggers. Here's another tip. The leading stocks tend to be the first stocks that bounce back from market corrections or price declines, and they may also be the stocks that show abnormal strength.
Very good, very good. The next is I, means institutional sponsorship. Institution means mutual fund, hedge fund, and management firm. If stocks doesn't have institutional ownership, it means the company has been rejected from the sky of business.
I know this one. We have to look for stock that has institutional ownership, at least 3 or 10 institutional owner.
Bravo, Mr. Mercy. Bravo. And now, Mr. Leo, what do you know about the M?
M stands for market direction. We can be right on every one of the previous 6 factors in CanSlim. However, if we're wrong about the direction of the general market, and that direction is down, 3 out of 4 of your stocks will plummet, along with the market averages, and you will lose money. such as the people that bought and held through the bear markets in 2000 and 2008. The general market refers to the most commonly used market indexes. These include the S&P 500, the NASDAQ, the Dow Jones Industrial Average, and the New York Stock Exchange Composite. These key indexes are important to study to see whether or not the current market is in a bull market and constantly delivering higher highs and higher lows, or whether the market has peaked and is pulling back. In order to understand this better, we need to better understand basic charting. We need to know where levels of support and resistance are, and understand moving averages. Never blindly let a stock lose value without having some sort of stop loss, because when a stock begins to rapidly sell off on high volume, such as GoPro in 2015 and 2016, we need to have an exit plan to protect our money. The key to staying on top of the stock market is not knowing or predicting what the market is going to do.
Yes, amazing, brother. Amazing. Remember, do not fight the market because it is bigger than you are. Just enter when the market is bull. And the direction is that the market is very dominant in determining whether you gain or loss in the stock investing.
After we pick the stock in part 1, what do we have to do then?
Well, after part 1, let's go to the second part. This one is super duper important. In fact, selling should be considered right before buying the stocks. Writing down the price at which you expect to sell if you have a loss as well as the expected profit of all the stocks you purchase. Only to mention, investors can be good at stock selection, but because they have studied and the right understanding, but they can be ignorant about why, how, and when to sell their stocks.
So, there is a good choice. What about the bad choice?
Yeah, it happens if the price of the stocks drops below your purchase price. The secret winning in the stock market is to lose at least the amount possible when you are not right.
What are the correct action we can take if we choose the wrong one?
Just sell the stock, cutting your loss when it's 7% or 8% below the price you can pay. Letting your losses run is the most serious mistake made by almost all investors. Having courage to sell in the only way you can protect yourself against the possibility of greater losses. It's a dangerous policy to assume that because a stock goes down, it has to come back up. Many don't, and some take years to recover.
So, what to do if our stock price goes up? Should we keep it or should we sell it?
Sell. Sell on the way up while your stock is still advancing and looks strong to everyone else. Sell your stock. If it increased 20% from the purchase of price, it is far better to sell early. If you are not early, you will be late. You never sell in the exact top, and 20% gains in 3 or 6 months will substantially more productive than the 20%. This gain in 12 months to achieve, so deal out while the stock up.
That's correct, Mr. Mayor. Remember on this saying, do not put eggs in one basket. The more you diversify, the less you will know about the other area. The best results are achieved through concentration. Putting all your eggs in just a few baskets that you know a great deal about, and continuing to watch those baskets very carefully. Most people with 20,000 to 100,000 to invest should consider limiting themselves to only 4 to 5 carefully chosen stocks. The winning investor objective should be to have 1 or 2 big winners rather than dozens of very small profits.
I see. So, the more important points made in this part 2 is to sell when your profit is at 20% and also to sell when you are losing at 8%. Ya salah.
Okay guys, Now listen to your Jidaya master. There are 9 skills you must have according to O'Neill. First, delay your gratification. Pro investor practice patience and invest upfront to reap long-term rewards. Second, distinguish myth from the truth. Pro investors don't believe everything they hear in the news. They don't panic about money bubble, bursts, or crashes. Third, become financially trained. Pro investors work for their business, not in their business. Pro investors use their own assets to work on them rather than them working for money. Fourth, leverage your time. Pro investors work smart, they don't work hard. They leverage time by investing early for the long term. Fifth, discipline yourself. Pro investors practice daily self-discipline. They wax on and wax off consistently and persistently on their daily, weekly, monthly, and annual goals. The sixth is master your emotion. Pro investors take cool reaction to external circumstances. They pause, will weigh the option and response in a way that creates outcome they want. 7. Just decide. Pro investors are decisive. They trust their intuition, decide promptly, and course correct along the way. The 8 is persist. Pro investors plan their work and work the play, even when they don't feel like it. Once they have chosen their investment vehicle, they go deep and quiet. And the last one is lead yourself. Lead the team. Pro investors know who they are, avoid their strength, source their weakness, and know where they invest. Now, according to the book, what are the common mistakes that you should avoid?
1. You must think in terms of the number of dollars you're investing, not the number of shares you can buy. 2. People buy company names they are familiar with, names they know, and that's a mistake. 3. Personal feelings and opinions are far less accurate than the market.
But I would like to add another 3 that in my opinion are the most important to know. First, stubbornly keep waiting and hoping not to cut loss, but the loss getting bigger and it costs them dearly. The second one is worry too much about taxes and commission. Your key objective should be first to make a net profit, not for too much worry. And the last one is investors are usually influenced by things that are not really crucial, such as stock split, increased dividends, and news announcement.
Exactly. Now you go practice. I hope you can buy that kryptonite you want to defeat Superman. See you.
This time for stock. It is important to understand chart. Canceling is a winning system to beat your stock. Knowing when to sell. If it goes down to 8%, you may sell it. If it goes up to 20%, to gain a profit, you must sell it. If you don't sell it, you won't get the profit. Only enter in bull market. Market direction is very important. The market is much bigger than you are.
Hey bro, we already got some profit from stock. Shall we buy the kryptonite?
No, this stock thing is more interesting.
But what about our operation? What about our plan to defeat Superman? Or Syndicate?
Don't forget it, guys. We rich now. From now on, no more crime. Okay? We get our fortune from stock.
Finally!
Yeah.
I agree with that.